Okay, welcome everybody to the latest installment of the BQE, the Brooklyn Quant experience. Today we're extremely pleased to have Samim Ghamami as our speaker. Samim is also teaches in the FRE program. And let me just read from his bio. So he's a senior researcher at NYU and at UC Berkeley, senior economist and managing director of the Financial Services Forum, and an adjunct professor of finance at NYU. So Ghamami serves on the advisory board of the Math and Finance program at Quant. He's also been a senior financial economist and senior vice president at Goldman Sachs, an associate director and senior economist at the U.S. Department of the Treasury, Office of Financial Research, and an economist at the Board of Governors of the Federal Reserve System. His work is broadly focused on financial economics and more recently on the interplay of finance and macroeconomics. Ghamami's been an advisor to the Bank for International Settlements, also worked as an expert with the Financial Stability Board on post-financial crisis reforms. He served on the National Science Foundation panel on financial mathematics in 2017 and 18. Samim has mentioned that he's willing to take questions during his talk. So if you have any, just unmute yourself and fire away. Samim, the floor is yours.
Thank you very much, Peter. Thank you. It's great to be virtually back at NYU, and it's great to present at the BQE lecture series. Thank you very much again, Peter. So the presentation will be essentially based on a recent paper, Collateralized Networks. It's a joint work with Paul Glasserman and Peyton Young. And it's also based on two risk articles published last year. The title of the presentation, as you can hopefully see here from the slides, is The Impact of Collateral and Stays on Financial Stability. So what is the motivation of this work? We want to study contagion, mostly in over-the-counter derivatives markets. And by contagion, essentially, I mean the spread of losses and defaults through the financial system or financial networks under two specific regulatory and policy reforms after the 2007-2008 financial crisis. These are the collateral requirements and bankruptcy and resolution stay rules. I think you are familiar with these two policy reforms, but I would just briefly mention here. So collateral requirements in, for example, over-the-counter derivatives markets have been present in the centrally cleared parts of markets even prior to the crisis. After the financial crisis, they were also came into play in the so-called bilateral markets. So if two large financial institutions, for example, two banks, want to trade in OTC derivatives, they need to exchange margin in the form of variation margin and initial margin. In the context of this presentation, I would mostly focus on collateral in the form of initial margin. And the amount of initial margin exchanged in OTC derivatives markets is quite substantial. So for example, here I have one simple statistic from ISDA from March 2020 that collateral, that IM against interest rate derivatives and credit default swaps exceeded 300 billion last year. And in terms of bankruptcy and resolution stay rules, if you're familiar with this topic, the evolution of bankruptcy and resolution stay rules in QFCs, qualified financial contracts, derivatives being a subset of them, has had a complicated form. I won't go through all the details in this presentation. Perhaps it would be enough to just mention that prior to the default of Lehman, derivatives were exempt from bankruptcy stays. After the default of Lehman, as part of the regulatory and policy reforms, stays were imposed on derivatives as well. So today, if a large financial institution becomes under distress or would default, its derivatives counterparties or derivatives creditors can't immediately terminate their contracts with a failed bank, for example. Resolution authorities would impose a stay of, for example, 48 hours, mostly 48 hours in the US, longer in Europe. And during that stay period, what happens is essentially the creditors' termination rights would be canceled and instead granted to the debtor or resolution authorities. So that's the essential difference between pre-Lehman and post-Lehman bankruptcy and resolution stay rules.
Oh, so maybe this is Leon. Can I ask you a question? Maybe this is Leon.
Sure. Hi, Leon.
Hi, so question. Today, if you do a purely over-the-counter derivative that's not cleared through a CCP, okay, a bespoke, right? Does the reason or the requirement to demand margin, is that emerging from the fact that the rules require you to capitalize counterparty risk, or are there actual distinct rules that say even if you trade something purely bespoke, you know, no CCP clearing, nothing, you're still obligated under some separate regulations to demand collateral, to demand that you have a collateral agreement in the either in the confirmation or the master agreement or whatever?
Yes, there are separate rules and regulations. So there are some thresholds and limits above which, even in bilateral markets, following your example, firms would need to, large financial institutions would need to exchange collateral in the form of initial margin. So even below those thresholds and rules and regulations, sometimes counterparties to OTC derivatives trades in bilateral markets would, like you mentioned, under ISDA type agreements, they agree among each other
right.
to exchange margin. But there are rules and regulations. So essentially we have centrally cleared margin rules and bilateral margin rules. And you see initial margin in these two sets of rules, and they are quite similar in terms of the mechanics of posting and exchanging variation and initial margin. Yep.
And I guess the Basel rules, Basel III says that no matter what kind of derivative it is, you have to separately calculate capital against counterparty risk, right? And
yes.
Right, gotcha. Okay, thank you very much.
Yeah, sure. So now in the next 2-3 slides, I would just intuitively go through the findings of this work, and then I would, because the findings are model-based, then I would go through the model itself. Okay. So the first finding has been that the existing network models in the literature can't be used to study contagion under collateral and bankruptcy stay rules. The intuition behind this result is that under both set of rules, okay, both collateral and bankruptcy stay, firms can benefit from the default of each other in the following sense. Suppose that consider two banks, Bank A and B. Bank A has committed initial margin held in a custodian entity to Bank B. If Bank B defaults or goes under distress, the initial margin that A has posted to B can be returned to A, so A would potentially have more financial resources to commit to its other counterparties. So in some sense, in some occasions, nodes in a financial network can benefit from the default of each other in the presence of committed or segregated collateral. Similarly, for stays, suppose that Bank B has at Bank A's default would have in the money derivatives contracts with Bank A. So if it is allowed to immediately terminate the contracts with A, or maybe after a period of time after the stay period, then during the bankruptcy or resolution proceedings, it may recover some payments from Bank A. So you see this notion of benefiting from defaults also being present in bankruptcy stay rules. So why this feature would make network modeling complicated? The reason is that most of the network models in the literature rely on fixed point type theorems, for example, Tarski's fixed point theorem, and most of the time these theorems rely on monotonicity assumptions. So when firms benefit from the default of each other, these monotonicity assumptions get violated. So we need to spend more time developing a network model where we can find a way around this violation of monotonicity assumptions that you see present in almost all the fixed point theorems. Okay, so that's the first finding. So in the interest of time, today I will not go through how we captured fire sale effects in collateral requirements when collateral is held in illiquid assets. Essentially, we borrowed ideas from another paper, Cifuentes, Ferrucci, Shin, 2005, to also model fire sale effects when collateral is held in illiquid assets. So I won't elaborate on that in the presentation today, but would be happy to answer any questions that you might have.
Samim, I just have a comment about the in-the-money derivatives.
Sure.
Let me contrast two situations. The derivative is an option, which has a convex payoff, versus the derivative is a bond under the possibility of default, which we could say has a concave type payoff. So if terminates means that, the pre, you have either of those two derivative securities before they mature, and then in some court they say payout is intrinsic value, then I'm thinking for an option, whether it's in the money or out of the money, forcing the option price to its intrinsic value lowers value. So that, let's call that a cost. Whereas for, say, a bond prior to which can default, and we're prior to that maturity date of the bond, so there's concave payoff, then forcing to intrinsic raises value. So that's an example of benefit. Is that how one should be thinking, or have I misunderstood this sentence? This short phrase?
Yeah, so that's the way to think about it. A contract, first contract, based on what you mentioned, contract termination prior to the maturity of contract. But there are two different ways to value the contract at termination. One is exactly like you mentioned, based on intrinsic value. The other is based on market value.
Okay.
That need not be equal, right? So we may, So we may, when I want to terminate, for example, an exotic option, and if I don't want to calculate or estimate its intrinsic value, I may go through a poll or auction to see what are the market values of similar contracts, take the average, and that would be the market value.
Okay. So, I mean, the main point is, let's say a court forces a possible change in value. It could be positive or negative. Exactly. And that's the point. It could be positive. That's the main point of this. Okay.
Yeah.
Okay.
Okay. So the second finding is that collateral need not support financial stability. Essentially, by that I mean collateral may increase contagion. And the reason behind this is also intuitive, particularly when we think about collateral in the form of initial margin. So recall that initial margin by definition and design may lead to collateral in excess of current payment obligations. Why I say by definition and design? Because initial margin most of the time is calculated based on value at risk type models. So by definition, it is supposed to capture the potential extreme movements of portfolio values. So because of that, it may exceed the current payment obligations of banks or firms to each other. Okay. So when you have excess collateral in the financial system, that may lead to inefficient allocation of a firm's assets. Okay. So one would allocate and commit excess collateral to one counterparty. Because of that, may not have enough financial resources to make current payment obligations to other counterparties or other creditors. Okay, so this is quite intuitive. The second topic I would just briefly mention is that it is relatively well known that yes, collateral will reduce counterparty credit risk, but it may actually put some pressure on funding liquidity at large financial institutions. So in some sense, collateral may transform counterparty credit risk to funding liquidity risk. I mentioned before that if collateral is held in illiquid assets, we may also have fire sales in the financial system that could also create some market losses at firms that would, hold illiquid collateral on their balance sheet. Okay. The second finding is that full contract termination may actually reduce contagion. So one can think of full or symmetric contract termination as the scenario in the absence of stays, or one can think of full contract termination as a scenario where the debtor or resolution authorities would decide to immediately terminate the contracts as opposed to retaining the contracts over the stay period or selectively terminating the contracts over the stay period. Okay, and before I introduce the model, it might be difficult to get the intuition behind this result, but I would just mention that this result holds when firms are not highly leveraged in terms of their derivatives transactions. So if you can have this condition in mind, low derivatives leverage, then I would elaborate on this result along the way. Okay. So to introduce the basic model without going through all the mathematics behind it, I use this simple example. Here you see three highly stylized three-node networks. And let me start by this one. So here you see a three-node network. A has a nominal payment obligation to C worth 4. Payment obligation of A to B is 5. B to C is 5. The collateral, let's say collateral in the form of initial margin that A has committed to B is 10. And A has initially 0 cash or cash-like assets on its balance sheet. C has 0, B has 5. And by default, in the context of this presentation, I do not mean default because of solvency problems. I mean default because of liquidity issues, and I'm mostly interested in liquidity type prices. So here, A can't fulfill its payment obligations to B and C. A would default, but because of committed collateral to B, B would seize and liquidate 5 out of the initial margin of 10, so gets its payment receivable from A, and with some delay, the excess collateral of 5 would be returned to A, and let's say, imagine that during the bankruptcy or resolution proceedings, the excess collateral can be used to make the payment of 4 to C. So A would default because of liquidity issues and the committed excess collateral to B, but at some point would have enough to also fulfill its payment obligation to C. Okay. Now so it would be great if you can have this first network in mind, because I'm gonna explain the baseline model using this first three-node network. In the second network, similarly, you see that C would default, again, because of liquidity problems, zero liquid assets on its balance sheet. And when C defaults, A's committed collateral to C would be returned to A. So A would have more resources on its balance sheet. Similarly, in the third network, you see that A would default, right? Again, because of liquidity problems. B would immediately seize and liquidate A's collateral. But at the end of the day, because C has a payment obligation of 4 to A would be left with some available resources on its balance sheet after its default. Okay. So, let me just revisit this first example when I introduce the model. So I would need to introduce some notations here. P bar ij is the nominal payment obligation of I to j. Think of a network model consisting of n nodes representing banks or financial firms in the network. Ci, cash or cash-like assets initially held on node's balance sheet. The total collateral committed by node I to node j is pi times mij. Mij is the shares of collateral committed by I to j, and pi is the unit price. So when we wanted to capture fire sales effects, for simplicity, we said, okay, one type of asset, illiquid asset, would be held as collateral for all these nodes in the network model. So this is the unit price, total shares of collateral. And what is delta ij? Upon I's default, J would liquidate some shares of collateral committed by I to J at default. So if you recall this example, so when A defaults, B delta ij would be 5, because the nominal payment obligation of A to B is 5. Okay, so here, go back here. So delta ij for that particular example is 5. Okay, so what is the allocation rule? First, what I mean by allocation rule: suppose that a firm would default and the remaining assets on its balance sheet during the resolution or bankruptcy proceeding should be allocated to its creditors and counterparties. So in the absence of collateral, it's intuitive that the allocation rule should be proportional to the payment obligation of I to J, right? In the presence of collateral, it is also intuitive that the allocation rule should be also proportional to collateral. Ultimately, it would be proportional to the nominal payment obligation of I to J, net collateral that I has committed to J. And it should also be noted that collateral prior to the default of node I would be considered as node I's asset, but the moment that node I would go under distress, it would be considered as J's asset, right? So that's also an important point here. So now the baseline model, I would give the intuition behind the baseline model. The baseline model is a two-round model. It's a two-round model in the sense that the first round would capture collateral prices and payment obligations up to excess collateral. The second round would capture payments and prices when excess collateral could be returned to the failed nodes, and the failed nodes could potentially make additional payments after default to the creditors. Okay, so again, it is useful to think of this example. So in the first round, B would liquidate 5, get its payment of 5. In the second round, excess collateral of 5 has returned to A, and this is in the second round that A can make a payment of 4 to C. Okay, and this is realistic in the sense that there would be some delay in bankruptcy and resolution proceedings, it would also at the same time enable us to get around this monotonicity issue that I mentioned to you. So it happens that when we do this decomposition of payments, in each round separately, we can employ Tarski type fixed point variance. Okay. So using the notation that I previously introduced, what are the payments in round one? Again, consider node ij. In the context of that example, firms A and B. What is the actual payment in the first round going from A to J? Obviously, when I to J, when I is not in default, it would be the nominal payment obligation of I to J. What do I mean by default? It is the classical definition of default with one exception. Because I care about liquidity problems, I would say when liquid assets fall below the nominal liabilities, nominal payment obligation. So what are the liquid assets on I's balance sheet? The cash and the payments that node I would receive from other nodes. Okay. So what is the actual payment from I to J? When I is in default, obviously it would be the minimum of the nominal payment obligation of I to J, the collateral committed by I to J, and using the allocation rule also depends on the remaining assets of on I's balance sheet at default. So what is delta ij? It would be 0 if I is not in default, and the shares of collateral liquidated by J at I's default would be the minimum of total shares of collateral, and also depend on the payment obligation of I to J, and I need to normalize by the collateral price. I won't elaborate and go through the fire sales effect, but it would probably would be sufficient to just mention that the fire sales effects have been captured by a simple exponential price impact function. So what
I got a question. The use of this minimum here, is that consistent with the earlier statement you made that a firm could benefit in the event of default on a counterparty? Because I'm thinking you're using the minimum to prevent any benefit from default.
So that's a good question, but we use the minimum. So the minimum is used in round one because in round one, I'm not capturing the excess collateral that can be returned to node I, right? So what happens is the use of minimum here only means that the collateral that B in the please think of in the context of that example, the collateral that B can get from A cannot exceed the payment obligation of A to B. So here, the minimum means when B defaults, B has 10 units of collateral from A, but A owes only 5 to B. So B cannot take 10, can only take 5.
So B cannot benefit from A's default is a way of shortening what you're saying.
Exactly.
Yeah, in this round. I mean, maybe
This
later.
round,
Yeah. Okay, that's fine.
Yeah.
Okay, so we're clear. Okay.
Okay, so I also mentioned this exponential price impact function that when you have more and more defaults in the network model, so this delta would go up because creditors would liquidate, let's say, the illiquid collateral of the failed banks, and that would uniformly decrease the collateral price, uniformly in the sense that collateral has been assumed to be held in one particular asset class. So this is the first round. What happens in the second round is, again, going back to that example, so what is the nominal payment obligation of A to B in the second round? Okay, so A made a payment of 5 to B in round one. Its nominal payment obligation was 5, so this is 0 from A to B. But how about A to C? A to C here, going back, A to C, the nominal payment obligation is 4. No payment went from A to C in round 1, but collateral worth 5 returned to A, right? So the nominal payment obligation of A to C is 5, 0 in round 1. So this is carried over, this nominal payment obligation is carried over the second round, right? So because of that, we're going to have returned collateral in the second round. Here, node A has defaulted. What is the returned collateral? Mij in the context of that example, 10 minus delta ij, 5, it would be 5. And because of this, the payments, the actual payments going from I to J in the second round would also depend on the returned collateral. Would also depend on the returned collateral. So without going through the details, just mentioning the intuition, because some collateral would be carried over to the second round, we're going to have also collateral fire sales effects in the second round, and that would be captured by what I have denoted by gamma I. So in sum, we have 2 rounds. The baseline model has 2 rounds. The first round has some payments, collateral prices, similarly payments, collateral prices, and we can formally show the existence of, using fixed point theorems, show the existence of clearing payments and prices for both the first and second round. Okay. So that's the intuition behind the baseline model. Now let me use this framework to show the trade-off between what I call committed collateral, let's say collateral in the form of initial margin, and pooled collateral. Okay. And what I mean by pooled collateral, going back to this example, I simply mean contrast this scenario with the scenario that this 10, as opposed to being committed to B and held in a custodian entity, is held on A's balance sheet. So I'm going to pool this back to A's balance sheet. So this is scenario B. Then for this particular example, A will not default. Okay. So that's what I mean by contrasting pooled and committed collateral. So here, the general result is that when we don't have excess collateral, it's very difficult to identify conditions under which pooled collateral is better than committed collateral or the other way around. Everything would depend on the distribution of collateral in the financial system. Okay. So one thing to mention is I only mentioned the number of defaults so far as a measure of contagion. A second measure of contagion would be the so-called system-wide payment shortfalls. By that, I mean consider the set of nodes that would default in the financial system and think of the difference between their nominal payment obligations to other nodes and the actual payments that have been flown out of those nodes. So take the difference, add them up across the default set, and that would give you what I call the system-wide payment shortfall. Okay. So our formal result here is this, that when we have excess collateral, contagion risk can increase. So formally, what I mean by excess collateral, as I mentioned before, collateral in excess of current payment obligations. Suppose that pi is 1, so this is the total collateral committed by I to J. The Mij minus P bar Ij, the positive part of that is excess collateral. We also have a result on what happens when we have proportional collateral. What do I mean by proportional collateral? Proportional to the current payment obligations of node to each other. So this formal result says that pooling excess collateral reduces defaults and doesn't affect payment shortfall. Also under proportional collateral, pooling that preserves proportionality reduces defaults and doesn't affect payment shortfall. So this first part is particularly relevant for OTC derivatives markets because, again, as I mentioned at the beginning, by definition and default, by definition and design, collateral in the form of initial margin may lead to excess collateral in the financial system. So I have, in the interest of time, I'll skip this example, but I also have this example where you can see a more realistic version of the allocation of collateral in a network model compared to that simple 3-node example that I mentioned before. If you are interested, at the end, I would also discuss what happens if firms have delayed access to illiquid collateral. So these two slides would mainly focus on the impact of collateral fire sales. I will not go through this. So now let me mention how we can augment the model to capture the contract termination payments at default, so that I can also say something about the stay rules that I mentioned at the beginning. So before introducing the notation for the augmented model, this simple example would help. So here also we have a simple network of 3 nodes. Again, because of liquidity problems, A would default. Please ignore this red arrow for the moment. So A having a nominal payment obligation of 4 to B, 2 to C, only having 4 on its balance sheet would default. Default of A would lead to the default of C. But suppose that now at default, we have full symmetric termination. Full symmetric contract termination, let's say for derivatives portfolios that these firms would hold with each other. And suppose, consider this scenario, that at termination, it happens that at the portfolio level, the portfolio value would be out of the money from B's perspective. So B would need to make some payments to A, and that is 2. So again, you see this feature that yes, A would default, but because of the presence of this full contract termination payments, A may end up being able to fulfill its nominal payment obligations during the bankruptcy or resolution proceedings, because it would receive a payment of 2. So this is from A's perspective. So at the beginning of the presentation, I mentioned derivatives leverage condition when we want to study the impact of stays on contagion. So here, the derivatives leverage condition come into play when we take the perspective of node B. So here, B has 4, let's say, units of cash or liquid assets on its balance sheet. The derivatives liabilities of B are 2. So when B makes a payment of 2, it wouldn't put B under distress. But suppose that this payment was 20. If the derivatives liability of B was 20, having 4 on its balance sheet, making this payment could, in principle, distress node B as well, right? So because of this, when we want to augment the baseline model and capture the derivatives contract terminations in round 2, we see that after round 1, these contract termination payments could trigger more defaults. So because of that, the augmented model can reach equilibrium intuitively in more than 2 rounds. We show that it can reach equilibrium in n rounds, n being the number of nodes in the financial network.
I mean,
yes.
I'm sorry, this picture over here. So if A defaults, or under the old model, if A defaults, then if
So if under the old model,
owed B money, then B could raise, right? I'm sorry, go ahead.
No, go ahead. I didn't hear you. Sorry.
No, I was just saying, so, okay, I want to understand this. So in other words, okay, so A defaults, right? Now, the value of a derivative that A has with B is $2, right?
Mm-hmm.
So under the old model, the value of that in the money value that A has in a derivative with B, A would receive.
Yes.
Right. But under the new model, it is a stay, right? But the stay is basically for like preventing B from liquidating collateral.
Yes. Yes.
But here you're talking about, so in other words, I default, right? I have a derivative, I have a swap on with B, it's in the money.
Yep.
I can still ask B for a payment. The stays don't prevent me from asking B for a payment. Is that correct?
Yeah,
Am I saying?
No. So that's it, Leon. That's a good point. But so the old model, which I call the baseline model, is a two-round model that captures collateral, right? Here, the augmented model in its original version is the augmented model under full contract termination. So in this example, I'm telling you intuitively what happens if all contracts will be terminated symmetrically and fully. So think of this example as a scenario either in the absence of any stays or in the presence of stays, but in a scenario where the resolution authorities would decide to immediately terminate the portfolios between the debtor and creditor. Okay, so that's what I mean. That's why I emphasize full or symmetric termination. So the baseline model on the collateral, the augmented model on the collateral, and in the presence of full contract termination. Okay.
Thank you.
Sure. So let me introduce the only notation that I would need here. So this, okay. So this payment going from B to A is denoted by VBA, okay, or VIJ. Okay, so VIJ is the positive value to node J of its derivatives contract with node I. So if VIJ is positive, from the perspective of J, the derivatives portfolio is in the money. From the perspective of I, out of the money, because of that, I has a payment obligation at default to J. And the other way around. Also, I mean, the relatively realistic assumption is that at the portfolio level, all contracts would be netted. So this VIJ is a portfolio value, and because of netting, VIJ times VJI is 0. Okay. So without going through the mathematics of the augmented model, I would just rely on the intuition. The first round is exactly similar to the first round of the baseline model, but after first round, these contract termination payment obligations would come into play. Okay, these contract termination payment obligations would come into play, and depending on the leverage of firms in terms of the derivatives transactions, because we're going to have potentially more defaults in other rounds, the default set could exceed the default set of the baseline model. And ultimately, we have a similar existence result in the sense that we can define the equilibrium payments and collateral prices for all the end rounds. Okay. So now let me use this augmented model to tell you about the first result on stays that I mentioned at the beginning of the presentation. So suppose that we want to measure the impact of full termination versus selective termination on contagion, right? So the augmented model captures, as I just explained through that example, the full termination scenario. By selective termination, let's say I mean the scenario where creditors would terminate only if they have in the money portfolios or contracts from their perspective. They won't terminate out of the money contract. So one can think of Lehman, and that when Lehman defaulted, some of its derivatives counterparties selectively, essentially they cherry picked. Okay, so one can think of selective termination as a scenario exactly like just I explained. Okay, now we have this augmented model. I also can modify that augmented model to selectively capture these contract termination payments. That variation of the augmented model, I would call that the Q model. So the P model is the original augmented model. Q model is the model on the selective termination. I have two measures of contagion, number of defaults and payment shortfalls. This is the number of defaults under full termination, under cherry picking or selective termination. Similarly, payment shortfalls, okay? Again, without going through all the details, I mentioned the derivatives leverage. So to measure derivatives leverage, I would need to have some type of definition for the net worth of nodes in the financial system. What is the net worth? The cash or liquid assets available on nodes firm's balance sheet, the return collateral at the end of round one, the payments that the node would receive from other firms in the financial network minus the total liability. Now here is the formal result, and hopefully it becomes a little bit more intuitive now. The result is that when firms are not highly leveraged in terms of their derivatives contract, in the sense that their net worth would exceed their derivatives liabilities, then full termination outperforms selective termination in terms of the number of defaults and payment shortfalls. In other words, full termination can reduce contagion when compared to selective termination under this derivatives leverage condition. So one may say that, okay, this derivatives leverage condition is too restrictive because it will be imposed on each firm in the financial system. So we can loosen this a little bit. So we have also aggregate derivatives leverage. When you add up the net worth of firms in your financial system and compare it with the total liabilities of the firms in the financial system. Okay. So in general, intuitively, when the financial system is not highly leveraged in terms of derivatives contracts, full termination can actually reduce contagion. Now, before I conclude, let me also contrast full termination versus no termination. So this could also be interesting because, as I said before, full termination can be viewed as a scenario where either resolution authorities would immediately symmetrically terminate everything, or as a scenario in the absence of stays where creditors can immediately symmetrically terminate everything. And the no termination scenario can be viewed as a scenario where over the stay period, 48 hours or more, no derivatives contract would be terminated. Okay, so I would call that scenario, which is captured based on the baseline model, I would capture this no termination scenario under the baseline model, calling it the Q model, and the original augmented model called the P model captures the full termination scenario. So again, we can compare the number of defaults and payment shortfalls using these models, and one can see that again the derivatives leverage would come into play. So here again, similar to the previous proposition, if nodes are not highly leveraged in terms of the derivatives transaction, full termination can reduce contagion. We also have a similar derivatives leverage condition here. This condition essentially intuitively tells you that for nodes in default, their derivatives liabilities would be less than their derivatives assets. Meaning for nodes in defaults, at default, what they receive because of contract termination payments would exceed what they're obligated to pay to counterpart. So here I will conclude. So the first finding, as I mentioned at the beginning, was if we want to study contagion under collateral and stay rules, we need to deviate a little bit from the existing models. One thing that I didn't mention during the presentation was, yes, I compared the trade-off between pooled collateral and committed collateral. One thing probably worth mentioning here is that this trade-off is also similar to the trade-off between collateral and capital. Okay, think of collateral again in the form of initial margin, where you have excess collateral and it is committed to banks' counterparties, and think of capital as a pool, of, for example, liquid assets held on the liability side of firm's balance sheet in the equity portion of that. Okay, so these trade-offs are similar, and I'm mentioning this because policymakers, essentially BCBS and IOSCO, have been thinking after the financial crisis that collateral may reduce systemic risk more compared to the scenario where financial firms are just required to hold more and more capital on their balance sheet. So the result here shows that that need not be necessarily the case, because at least in the presence of excess collateral, we were able to show that contagion can increase. So when you have excess collateral in the financial system, contagion can increase. And finally, I tried to measure the impact of stay rules on contagion by considering full termination, selective termination, and no termination. And in those comparisons, as you saw in the previous slides, one thing came up again and again, and it was the derivatives leverage condition of banks. When banks or large financial institutions are not highly levered in terms of their derivatives transaction, full contract termination may reduce contagion. Okay, so I will stop here. Please let me know if you have any questions.
Samim, this is Ken Winston. I have a question. What's the volume of bilateral contracts now versus centrally cleared contracts? I mean, I guess I have the impression that it's vastly larger in terms of centrally cleared contracts.
I can, yes, that's a good question. Yes, it is quite asset class specific. So for example, for interest rate derivatives, exactly like you mentioned, vastly now toward centrally cleared markets. But another extreme point would be for foreign exchange derivatives. So for FX derivatives, the majority of contracts are still being traded bilaterally.
So would a central clearinghouse just be another node on this network? I mean, how would that work if there's one of these other resolution methods that you're talking about?
Okay, that's also a good question. So it would be just another node in the network with one difference. So suppose that it's node I in the network, then I would need to turn off MIJ. MIJ would be 0. If we think of collateral as collateral in the form of initial margin, because CCPs would receive initial margin from their clearing members and their clients, but they don't post initial margin to the members. So yes, a CCP would be just another node in the network, but it wouldn't commit collateral to its counterpart.
Thank you.
I have a question, Samim. Is there a mathematical definition of collateral? And what's prompting my question is a related question, which is collateral like more liquid than the derivative that it's supposedly collateralizing?
I mean,
okay, so let me do a concrete example. Like I'm promised $1 in a year, but I know my counterparty might default, so I make them post collateral. And the collateral he posts is some kind of toxic waste that may never pay off, and if it does, it pays off in 1 trillion years. Is that actually collateral by the definition of collateral, or not?
Yes, so by the definition of, by the classical definition of collateral, it can be, like you said, illiquid or it can be liquid. But after the 2007-2008 financial crisis in OTC derivatives markets, policy makers and regulators have forced rightly most of collateral to be either very liquid or cash-like collateral. So in the context of what we have been discussing, so against OTC derivatives contracts, both in the centrally cleared part of the markets and bilateral part, collateral would be held either in cash or high quality government bonds.
Okay, so but a high quality government bond could actually be less liquid than another high quality government bond.
Exactly. Yep.
Okay,
Yep.
so that's allowed. That
Yep.
you know, let's say that the collateral is less liquid than the government bond that it's collateralizing, for example.
Yes, yes. And
Yeah.
exactly because of that, whenever collateral is not held in pure cash, both CCPs and financial firms, you know better than me, would also estimate the so-called haircut value. So on top of a value at risk type model, calculating collateral in the form of initial margin, we would also need to capture that illiquidity by taking into account the haircut value. Yeah.
Okay. Are there any other questions?
So I mean, one thing, this could be a stupid question. My apologies in advance. You talked about payment obligation, okay?
Yes.
And you also were talking about these defaults being triggered by liquidity crises, not solvency, right?
Mm-hmm.
But when you say payment, you don't mean the next payment due on the swap. You mean literally the mark-to-market value, right?
Yeah.
The swap. So I'm curious why you use the term payment obligation as opposed to, that suggests to me like the upcoming payment, which they can't make because of a liquidity crisis, but you literally mean the mark-to-market value of the derivative.
So that's actually a very good question, Leon. So no, actually what I mean was the former, in the sense that, again, only in the context of OTC derivatives contracts and portfolios, it is useful to think of these P bar IJs as fixed payments due. Okay, we get into a CDS transaction, you and I, and these P bar IJs, I buy protection from you on a reference entity. These are the quarterly payments that I need to make. These are my quarterly payment obligations to you, these P bar IJ.
Right.
But VIJ would come into play when I become distressed, go into default. You need to terminate this CDS contract with me. You go out to the market and estimate its market value. That's VIJ.
Because you literally mean actually the upcoming payment that they can't make for some reason.
Exactly.
Okay.
Exactly.
I see. Okay. Okay.
Yep.
But of course, if there were no stays, right, and the counterparty, the surviving counterparty has collateral of mine, they could liquidate up to the value, right? Not the missing payment, only the whole value they could liquidate up to, right?
Exactly. Yes.
Okay.
Yes.
Okay. Thank you very much. Thank you.
Thank you.
Yeah.
Okay, I think we're done for today. Thank you for finishing on time, Samim.
Thank you.
Sure. So Abby, you can stop the recording now.